Good evening to you once again. My name is Adejuwan, and I'm one of your tutors for strategic financial management. We are three partners that will be doing justice to the syllabus of strategic financial management. Myself, Mr. Ashwaju, and then Mr. Ali. You had Mr. Ashwaju yesterday. And I think Mr. Ali took you on Sunday. Was it Sunday or no? You will take you this coming Friday. Yeah. Okay. So I will be the one to be taking you the class every Tuesday. All right. The scope of strategic financial management, the scope of CSME in the old syllabus is what Mr. Ali will be taking you, the theoretical aspect of SFM, the strategy scope, the risk management scope, the corporate governance, all those theoretical aspects of the syllabus are what Mr. Ali will be taking you every Friday. Of course, I believe Mr. Shuaju must have, listed his own scope of the syllabus to you yesterday. Today, I'll be dishing it out the areas where we are going to be dissecting during the course of these diets. All right. So, without bothering you with so much of stories, all right. As we proceed in the class, I'll be telling you one or two things as per your responsibility for you to what you need to do for you to succeed in the exam that you want to write, because most of the responsibility lies on you. You are the one paying you are the one making the sacrifice, you are the one that need this certification. Therefore, you have much to do for you to be able to succeed in the exam that you want to write. At all time, you have to set up your goals as you want to write this November 2026 diet. You have to set up your goal, what you want to achieve. Your primary goal, we don't have any other goal other than for you to qualify or for you to pass the subject that you want to write. Before it's too late, I need to confirm to you and I need to inform you. I need to advise you, like the relationship between lecturer and student. At this level, at this professional level, it is not appropriate for a student to be combining courses. This is not the level you are supposed to be combining courses. You're writing 2, you're writing 3. It doesn't make any sense. It's a waste of time. It's a waste of resources. You can't be doing that at this level because there's nothing strange to you in all the papers you want to write at professional level. Why am I saying this? Take for example, strategic financial management. There is nothing you want to do except about 2 or 3 topics that are not embedded in financial management at skills level. Okay, that have not been taught before, right? So you have the idea of performance management. You have the knowledge of financial management. I see no reason why you cannot deal with strategic financial management 100%. You have the knowledge of financial reporting. I see no reason why you cannot ask strategic business reporting. Okay? You have done tasks at skills level. So what is making you scared that you cannot write advanced tasks with other subjects? For those of you that are coming from foundation up to skill, then now professional level, you have done audits. So why are you afraid to combine with advanced audits? Case study incorporates most of all those subjects, particularly SFM, performance management, okay, and a bit of reporting. So there's no reason why you cannot write the entire 5 subjects at professional level. That is my point. Because by the time you begin to combine, it will delay your qualification and it will be more expensive for you. You can imagine spending 4 months preparing for the exams and you are writing just 2 or 3 papers. Then you have to start the cycle again next year. Please don't do that. It's a waste of time. It's a waste of resources. Don't do that. The fact that you write 2 papers is not the ultimate, that even the 2 papers that you are going to clear it. Everything is all about you. It is your level of commitment. It is your level of preparation that will determine the outcome. And that is why it is essential. You have to start very early. Show more commitment. Set your goal. Your goal is to qualify these diets. Write it conspicuously where you can see it. I want to qualify in November 2026. That should be your goal. Every day you should think about it. Please. It looks as if November is far. Before you wink, November is here. And that's why it is important for you to start your study now. At each day that you are being taught, whatever you are being taught, you must ensure that you go through them. Don't accumulate your notes, because once you do that, it will have implication. There will be consequence for doing that. Monday to Sunday, you should have minimum of 2 hours for you to read. This is very important. There should be no day that will pass without you studying. Please, this is very key. Yearly preparation is key to your success. I won't say more than that. All right? So, on each lecture day, I will be reminding you of your responsibilities. Okay? So, let's leave it at that. All right. Today, we are going to be discussing one of my scopes, which is the cost of capital. But before that, let me show you my cost outline. During the course of this class, we are going to discuss cost of capital. Let me see. Let me use this one to annotate. So we are going to discuss cost of capital. Cost of capital is foundational. It is fundamental to whatever you want to do in strategic financial management. There is hardly any quantitative topic that you want to mention in strategic financial management without the use of cost of capital. The beauty of this topic is the fact that, in fact, entirely the beauty of the new syllabus is the fact that ICAN has exposed you to financial management, which make life easy for every other student that will be writing SFM. And I love the new syllabus, okay? But at this level, what the examiner wants from you is your professional judgment. What the examiner wants from you is those ethical issues that surround strategic financial management. This is what examiner is asking you to bring out, because at this level, you are seen, you are a professional, you are seen as being representing the institute. At this level, you are seen as being representing your firm or your company. You are seen as being defending proposal with your clients. So whatever that is, anything that is short of a professional is not acceptable. The way you are expected to express yourself while you are in skills level is different from professional. Here is the ultimate. Here is the ultimate. So please, as we begin the journey for ICAN November 2026 diets, I beg of you, I want you to limit your cramming. I want you to limit your level of cramming. Cramming will not help you. At this level and at this stage, cramming will not help you. You have to ensure that you have the understanding of the basics. It is only when you have the foundational knowledge, you'll be able to express yourself the way you want. When you read a topic and you are able to write it down in your own language, that means you know it. But when you begin to cram, cramming will not help you, because when you cram, once you miss a step, every other thing will disappear. That is where you are going to stop. You can't go further. That is one of the demerits of cramming, because your capacity will be limited. But if you have understanding of the concepts, you will be able to express yourself deeply the way you want it, the way the examiner wants it. And that's why I'm encouraging you, try as much as possible. Anytime a lecturer is taking you something, and you must ensure that you understand it. If you don't understand, ask question. While you are in the class, you have rights over the lecturer to ask any question, and the lecturer will surely answer, respond to your inquiry or to your question. It's very important. Don't leave anything unclear to yourself, otherwise it will become a burden to you. All right then. So this cost of capital will take us for the next 5 to 6 periods. Like I told you, it's foundational. It's very big. It looks very small, but it's very big. There are a lot to be done. The reason being that cost of capital is has linkage to some of the topics in strategic financial management, particularly when we get to business valuation. We are going to make some calculation that relates to cost of capital. And if you don't have the understanding here, you are going to struggle when you get to the business valuation. All right. So that is that. Then once we are done with that, we then move to capital budgeting. Okay. Capital budgeting will take us minimum. At a minimum, will take us like 4 to 5 periods. Okay. To take off 4 to 5 periods. Then after that, we are going to discuss risk and uncertainty. Okay. Risk and uncertainty within 2 to 3 periods will be done with that. Then, of course, we have merger and acquisition. There's also business valuation, and match the two of them together. Merger and acquisition is purely theoretical. There is no calculation in M&A. The calculation of M&A will be done under business valuation. All right. Then I also included portfolio theory as well as the capital asset pricing model, even though they are not within your syllabus anymore. But that doesn't mean that ICAN cannot test you. Okay. ICAN can still come back and ask you a question on portfolio theory. There is no way you are going to talk about cost of capital that you are not going to talk about capital asset pricing model. Even in valuation, in business valuation, we are going to calculate capital asset pricing model. All right. So the portfolio theory, the capital asset pricing model is a bonus to you. All right, in this class, because I just introduced this. It's not part of your syllabus, but ICAN will test you. Okay. So in case you have forgotten, that's why I reintroduced it, just to test it. All right. So together we have practically about 4 months for us to be able to do justice to the syllabus. All right. So let's take it one after the other. All right. So we are going to start with cost of capital. Please open to the material at your end. Let's go through the topic together. Okay. Cost of capital. Let me see. Go to page 23 in the learning material. That's where you have cost of capital. Go to page 23 in the learning material, because I'm going to switch to the Word document I'll be used to express myself. All right, so you can open to this material at your end so that you can follow through together. All right, I will be switching to Word documents. My pen is not working, so I cannot annotate. All right, I will stop sharing this now, then move to, let me see, let me check my Word document first. Please, can somebody confirm to me that you can see Word document on the screen?
Not
What
yet.
document? Not yet.
Okay, that means it's not showing. So I was thinking that it will show, but in any case, let me stop sharing and all right then.
You can see.
Okay.
I can see.
All right, thank you. We're starting with let me put it this way. Let me include the fonts. Let me use Roman, then 14, so that will be bold. Cost of capital. Emma, it's my pen that is not working. All right. Okay, under this topic, let me do it this way. I'm just learning to use a Word document for class for the first time. So it's very strange to me. Anyways, okay, we are going to discuss introduction. After introduction, we discuss importance or categories, importance of cost of capital. We're also going to discuss categories of cost of capital. Then finally, we're going to have illustration. You can imagine this is the small topic that Mr. Adejuwon said is going to take for the next 5 to 6 periods. That is too much for this kind of topic, you know. It's a lot. Cost of capital is a lot. You will see by the time we begin. All right. So like I said, open to the material at your hand. Please, at all time, always check that the recording is on so that we don't miss out. All right. At times, I may want to switch or do one or two things and I forget to click recording. Please always check. All right then. And then if you have any question for me, always raise your hand, please. Don't disrupt my class with background noise or just disrupt my flow of lecturing by asking question abruptly, please. Okay then. We are starting with introduction. What do you understand by cost of capital? All right. Simply put, cost of capital represents the compensation required by the providers of capital, including the ordinary shareholders, preference shareholders, and the debt holders from their investment in a company. Okay, that's the definition of cost of capital. Let me put it down for you. All right. So, like I said, cost of capital. I didn't ask you to vote. Okay. Cost of capital represents the compensation required by the providers of capital, including the ordinary shareholders, preference shareholders, and debt holders from their investments in a company. Let me explain this. You know, when you say a company, it means that there are some individuals that have contributed their capital to finance the operation of the business. These individuals are known as the owners of the business. Therefore, the primary objective of any organization or the primary objective of any profit-making organization is to enhance the shareholders' equity value. If a company is able to earn a profit, okay, if a company is able to achieve profitability, it means that the shareholders' wealth will also be increased, all right? Because profit is a measure of performance. Provided the company is profitable, shareholders will be happy because it is from the profits that the company is going to pay dividend to the shareholders. So the shareholders that have contributed their capital to finance the operation of the business, they are expecting a return on their investments when the company does well in the future. So the return on the investment that the company is going to pay to the ordinary shareholders is the cost on the capital that the ordinary shareholders has given to the company to run the operation of the business. So to the company that is paying it, it's a cost, but to the ordinary shareholders that will receive the return in form of dividend, it's a return on their investments. Okay, because the dividend will be paid out of profits. The dividend will be paid out of profits. Therefore, it's a cash outflow, and that's why it's a cost on the ordinary share capital. The second provider of funds is the preference shareholders. The preference shareholders are entitled to fixed dividend in the company. Of course, they are not part of the owners of the business, but they have invested in the organization with the hope that the company is going to, with the hope that they are going to earn a return on their investment. So the dividend that the company, the fixed dividend that the company is going to pay to the preference shareholders is also a cost to the company, but to the preference shareholders, it's a return on their investment. Let's say, for example, a company wants to undertake a project or execute a project that worth like 1 billionaire, and the required finance is not readily available, the company may approach investors or a bank that, please, I need a loan. If the investor or the lender is going to provide the loan, it's not going to be for free. The company must pay interest on the loan. All right? So the interest that the company is going to pay will be out of the company's profits. Therefore, it's also the cash outflow. That's why you see immediately after operating profits before interest and tax, the next thing you are going to do is to pay interest expense. All right? So that interest is a cost to the company, but to the debt holders, it's a return on their investment, because the loan they have given to you is a form of investment in your business. All right? So the cost that the company is going to pay to all of these providers of funds is what is known as cost of capital, because each provider of funds has contributed capital to the business in different form. Okay? So that is basically what cost of capital is all about. It is determined. Cost of capital is determined. It is determined by the market forces of demand and supply. Of demand and supply, depending on the perceived risk. Depending on the perceived risk associated with the business or with the company. Okay, so that is, this means, let me go further. This means the higher the underlying risk, the higher the underlying risk, all things being equal, the higher will be the cost of capital that the company will pay. Okay, let me explain further. I mentioned two things here in this paragraph. I said that cost of capital is determined by the market forces of demand and supply. What that simply means is that when there are more customers or there are more companies or clients demanding for a company's loan, let's say, for example, we are few in the industry that are providing loans to customers, and there are many customers that are seeking for the loans. So because there are more demand than the supply, so it is natural that the cost will go up because there are little supply in the market. On the flip side, if there are more supply than the demand, customers are not demanding for loan. You will see that the cost the cost of capital will be lower because not many customers are seeking for loan. Therefore, the company may want to attract customers to come and ask for loan by lowering their costs. Okay, so it's high, cost of capital will be high. If the demand is low, cost of capital will be low. That's what we mean by it is determined by the market forces of demand and supply. Now, when you talk about the perceived risk, that's another angle. The risk of a company, the risk associated with a company will also determine the cost of capital that the company will pay. A publicly quoted company has a lower risk relative to a limited liability company, right? Therefore, if the risk associated with the company is high, certainly the cost of capital will also be high and vice versa. So this is introduction to cost of capital. The next thing we are going to discuss is the importance of cost of capital. Not everything I'll be writing down. I will just be explaining. You have the material at your hand so that we can cover as much as possible. All right. The next thing we are going to discuss is importance of cost of capital. Okay. Importance of cost of capital. So what are the importance of cost of capital? The significance of cost of capital cannot be overemphasized. Cannot be overemphasized, particularly in the determination or in the determination of optimal capital structure of a firm. Okay. Let me just give as a bullet point. The following are some of the key. The following are some of the key importance of cost of capital. All right. So examiner can ask you to discuss at this level. Yes, you can be asked to explain or discuss the significance of cost of capital. What are you going to say? It's something you already know. All right. Number one, project evaluation. Let me explain this. I'm not going to write notes. Project evaluation, what do you mean by that? In the determination of financial viability of a project, cost of capital is required to discount the future expected cash flow to the present value equivalent using relevant investment appraisal techniques like net present value, internal rate of return, modified internal rate of return, adjusted present value, and any other techniques in order to it will be almost impossible to appraise a project or to evaluate a project without the use of cost of capital. It will be difficult to ascertain the financial viability of a project without the use of cost of capital. So you will notice or you will recall that in your financial management, when you are calculating net present value, for example, you are expected to multiply discount factor with the cash flow that the project will generate in order to arrive at present value. because the future cash flow that the project will generate, you bring it to the present value equivalent. All right. So without the cost of capital, there is no way you'll be able to get your discount factor you are going to use to multiply with the cash flow. So it will be almost impossible to evaluate a project without the use of cost of capital. So one key importance of cost of capital is for project evaluation or investment appraisal. I believe that is clear. Number two, determining debt equity proportion. Determining debt equity proportion. Okay. Now, this is another importance of cost of capital. In the determination of optimal capital structure of a firm, cost of capital will enable a company to determine the mix of capital, that is, the proportion of equity and debt to be carried in the capital structure. Cost of capital will enable a company to determine what is the percentage of equity and debt to be carried in the capital structure. As a company, should I carry 60% of equity and 40% of debt? Should I do 50-50 or 30 of equity, 70% of debt? The cost associated with each source of finance will determine the proportion of each source that I should carry in the capital structure. The objective of a firm is to minimize the overall cost of capital. Each source of finance has its own underlying cost. Therefore, the company wants to minimize the overall cost associated with the capital. So without the cost of capital, you'll just be doing it anyhow. So it is that cost of capital that will enable the firm to minimize its cost. Note this. When you say capital structure, what we simply means is that capital structure is the way and manner a company finances its operation. Majorly, there are three sources of long-term financing, including ordinary share capital, preference share capital, and debt capital. So each of them has its own underlying cost, and that is what the company wants to minimize. Okay, so these are the two key importance of cost of capital. The first one is project evaluation, and I said that in the determination of financial viability of a project, cost of capital will be needed to discount the future expected cash flow to the present value equivalent using relevant investment appraisal technique. The second one is to determine, we use cost of capital to determine debt equity mix. That is, cost of capital will enable a firm to ascertain the proportion of equity and debt to be carried in the capital structure in order to minimize the overall cost of capital. All right. So these are the two key importance of cost of capital. The next thing we are going to discuss will then be the categories of cost of capital. Therefore, before I move on, I would like to ask you, in case you have any question for me, let me write down this before I then ask you. Category of cost of capital. So that's our next discussion. So I'm asking you, do you have any question for me so far? It's like I'm the only one talking. Let me hear your voice. Yes, any question for me? Okay. All right then. So let's move on. Okay, Ifeoluwa, talk to me. Yes,
All
go
right,
ahead.
please, sir, can you throw more light on the difference between the discount factor and the cost of capital?
Discount factor and cost of capital. The linkage, the relationship between cost of capital and discount factor is just that when you want to evaluate a project, you are going to need cost of capital to discount the future expected cash flow. All right? You are going to need cost of capital. It is that cost of capital you are going to use for your discounting. You know, there's a formula you are going to use for discounting, right? To calculate your discount factor. But you are going to, without the cost of capital, there is no way you'll be able to do the discounting. Okay? Ifeoluwa.
Yes, sir, that's clear, sir. Thank you, sir.
All right. So, categories of cost of capital. Anytime an examiner is asking you to advise on the appropriate cost of capital to be used for project evaluation, it means that examiner wants you to calculate cost of capital. This cost of capital can be calculated in 3 different ways, depending on the information available. All of them we are going to, that's what we are going to be discussing for the next 5 periods, okay? One after the other. Cost of capital can be grouped into, all right, cost of capital can be grouped into number 1, traditional. I didn't ask you to board it. Why are you boarding it? The first one is traditional weighted average cost of capital. Number 2, project specific. Cost of capital. And then number 3, weighted average cost of capital of the combined activities, which I call WACOCA. All right. So these are the 3 categories of cost of capital. Anytime you are asked to calculate cost of capital, this is what the examiner is asking you to do. It will be one of these 3. So we are going to pick it one after the other. The first item will be traditional weighted average cost of capital. Let's discuss traditional this Word document I'm using is more like a burden to me. It's strange to me, seriously. Traditional WAC. Okay. When do you calculate traditional WAC? Traditional WAC is computed when information about capital structure, such as ordinary share capital, preference share capital, and debt capital, including their underlying costs, like dividend and interest, are given in the question. So anytime you are asked to calculate cost of capital, and in the question, you can see information about ordinary share capital, preference share capital, or debt capital. In the additional information, you can see information about dividend and interest. You can see the market price of each source of finance. It means that you are supposed to calculate traditional WAC. So that is what you should look out for in a question. Okay? Let me put it down for you for clarity. This is computed when information about capital structure, such as ordinary share capital, preference share capital, and debts, including their underlying costs, such as dividend and interest, are given in a question or are given. Okay, so that is when you calculate traditional weighted average cost of capital. Once you can see information about capital structure and you're asked to calculate appropriate cost of capital, then you should know that you have to calculate WACC. Okay, therefore, how do you then calculate traditional WACC? Steps. So, calculating traditional WACC. What are the procedures? So what are the procedures are you going to carry out anytime you want to compute traditional WACC? Basically, there are 4 steps to be carried out when calculating traditional WACC. The first step is to calculate cost of equity. Step number 2, compute cost of preference share. Step 3, estimate cost of debt. And step 4, calculate weighted average cost of capital. It's no more than that. It's no more than that. There are just 4 procedures. However, it is possible in the capital structure, you may not have preference share capital. So if you don't have preference share capital in the question, it means that you are going to follow just 3 steps. You calculate cost of equity, cost of debt, then weighted average cost of capital. Those are the procedures. All right. So let me just put it down for you. Calculates cost of equity, step 2, computes cost of preference share. Step 3, determine cost of debt. Then step 4, estimate weighted average cost of capital. These are the 4 steps that you are going to carry out anytime you want to compute traditional WACC. It's no more than this. All right. So within the next 3 periods, we are going to be discussing traditional WACC. Once we are done with traditional WACC, we'll then move to project-specific WACC, and then finally, WACOCA. Okay? So let's begin to explain the concepts under each of the procedures. All right. Don't forget what I told you. At this level, don't cram. You must understand the basics. Once you understand the foundation, you have the fundamental, you have the foundational knowledge. You cannot struggle to answer any question. you are going to be freely expressing yourself on that day of your exam because you understand the concept. And that is why I don't want you to cram. If anything is not clear to you, ask question. As soon as you are done with a particular topic, research more. Don't limit your studying to what you are being taught in the class alone. Express yourself, go elsewhere, research more, look for textbook, solid textbook for you to gain more insights into the topic. By so doing, you'll be able to express yourself freely without cramming. Promise, no, it's not yet day of judgment day. It's not yet judgment until ICAN publishes the exam dates. That's when I will begin to be singing the judgment day for you. But for now, let's keep it low. All right. Okay, then. So let's explain cost of equity. All right. Cost of equity. Let me put it this way. Calculating cost of equity. Okay. So this is our next discussion. What do you mean by cost of equity? I'm not going to write it down. All right. So I will just explain so that it will save our time. What do you mean by cost of equity? Right? Cost of equity. I mentioned earlier today that there are three providers of capital: ordinary shareholders, preference shareholders, and then the debt holders. The cost that the company will pay to the ordinary shareholders is what is known as cost of equity, okay, in form of a dividend. Therefore, cost of equity is the minimum required rate of return expected by the ordinary shareholders from their investments in a firm. It is also known as opportunity cost of capital. Why is it called opportunity cost of capital? Because the shareholders have contributed their capital to finance the operation of the business. That same capital, they would have invested it somewhere else to earn even a better return on their investment. But they decided to invest their money in the company. So the benefit that would have accrued to the shareholders from another investment opportunity, that benefit is already lost. They can't get the benefit again, so it has been forgone. So because they've decided to invest in this company, they won't be able to earn benefits elsewhere again. That is why it is also called opportunity cost of capital. Okay? The management of a company must generate sufficient return over and above its cost of capital in order to create value for the shareholders. All right, let me just put a short note under this. I say cost of equity represents this. Okay, this represents the minimum required rate of return expected by the ordinary shareholders from their investments in a firm. Okay. So as a short note, I've already explained to you. So let's leave it at that. Paragraph. Cost of equity, or let me put it this way, methods of calculating cost of equity. Cost of equity, okay. Cost of equity can be calculated using one, dividend valuation model. Okay. Number two, capital asset pricing model. And then number three, Miller and Modigliani formula. Capital asset pricing model. Capping. It will take me time before I master these Word documents. I'm not used to it. That doesn't mean I don't use Word documents, but for lecturing, I don't use Word documents. That's what it is. Modigliani. Miller and Modigliani. Okay. M&M. These are the three methods of calculating cost of equity. So let's pick it. Let's start with dividend valuation model. Dividend valuation model. When do you calculate cost of equity using dividend valuation model? All right. You have to know what to do, because on the day of your exam, particularly at this level, examiner will not tell you to use a particular method. In most cases, it is implied in the question. Examiner believes that you know what you are doing, you know the right thing to do. Okay. So when you want to calculate cost of equity, it can be, you can either use dividend valuation model, capital asset pricing model, or Miller and Modigliani. So how would you know in a question that you are supposed to use dividend valuation model? What are you supposed to look out for you to know that you are supposed to use capital asset pricing model or Miller and Modigliani? These are the things we are going to be discussing. So the first one is dividend valuation model. This is used to calculate cost of equity when information about dividend and share price are given. Okay, so if in a question you are given information about dividend and share price, and you want to calculate cost of equity, it means that you are going to use the dividend valuation model. You are supposed to use the dividend valuation model. So that is the key thing you must look out for in a question. Okay. Once you can see dividend and share price, it means that you are going to calculate cost of equity using dividend valuation model. Under this method, cost of equity is computed as the ratio of dividend to share price. Okay? When you want to calculate cost of equity, simply divide dividend, the current dividend by the share price. That will give you the cost of equity depending on whether or not there's growth in dividend payments. Depending on whether or not there's growth in dividend payments. Okay. The formula below can be used to calculate cost of equity. All right. Let's move to the next page. So to calculate cost of equity, it's simply calculated as, let me insert my formula equal to all right, equation. Yeah, come on, no waste no time. Okay. So cost of equity will be calculated as current dividends divided by X dividend share price. Dividend, okay? Let me push this one down a little bit. Number A, where there is no growth in dividend payments. I hope this class is not boring with the way that I'm writing on the screen. So, this is really strange to me, seriously. This is really strange. Oh, let me forget about this. Let me just, okay. If in the question, the amount of dividend paid for each year are the same, that is, if dividend is constant, then the cost of equity will be computed as the ratio of dividend to X dividend share price, then multiply by 100%. Multiply by 100%. Okay, so that is the formula to calculate. All of you, or majority of you, you're already familiar with this. Nothing is strange. It's the same thing you did under financial management. So we're just recapping, or this is more like a refresher. Yeah. Okay. So that is for that. The second one, where there's growth in dividend payments. Okay. Where there's growth in dividend payments. So where there is growth, how do you compute your cost of equity? All right. Cost of equity will be computed as current dividends multiplied by 1 hello, please let me. So where there's growth in dividend payments, cost of equity will be computed as current dividends multiplied by 1 plus growth rates, 1 plus growth rates divided by X dividend share price plus the growth rates plus the growth rates all multiplied by 100%. Let me sort. Yeah, that's my time. I might be new. I'm in a new environment, so I don't understand. Okay, let me do it this way. That sort. Why are we gray now? Okay. If you don't allow me, I will use this one then. If you don't allow me to use the format that I want, I will use this one so that my class will move on. What am I doing? Okay. So that's that. So this is the formula you are going to use to calculate your cost of equity, where there is growth in dividend payments. Let me use this one. I wanted to use something else before, but it's grayed out. Okay then. Yes, Promise, what's your question? Talk to me quickly.
All right, sir. So in a situation where in the question, div is given share price, what
Yeah,
are we to do?
don't worry, we get there. We'll discuss it shortly.
All right, thanks,
All
sir.
right? Okay then. So anytime you want to calculate cost of equity where there's growth in dividend payments, it's simply current dividend multiplied by 1 plus the growth rates divided by X dividend share price plus the growth rates all multiplied by 100%. Please don't make mistake by using your calculator to say current dividend multiplied by 1 plus growth rates plus G, then divided by X dividend share price. When you do that, you can never have the right answer. The best thing you need to do, the most appropriate thing to do is to divide the current dividend. You divide the numerator with the denominator. Whatever the answer you have, you then add the growth rate to it before you multiply with 100%. That's the best approach to do. All right. So that is how to calculate cost of equity using dividend valuation model. The next thing we are going to discuss is the concept of div and xdiv share price as far as cost of equity is concerned. Concepts. of CumDiv and XDiv share price. Okay. In the calculation of cost of equity using dividend valuation model, examiner may give to you CumDiv share price. If you are given CumDiv share price, you have to convert it to XDiv share price before you calculate your cost of equity. Otherwise, whatever you do will be wrong. Okay? So what do you understand by CumDiv? What is XDiv share price? So let's talk about them. All right. The first one is CumDiv share price. CumDiv share price. The CumDiv share price represents the share price that include dividend. Okay? CumDiv share price represents the share price that include dividend. In the calculation of cost of equity, CumDiv share price is not used. So if you are told in a question that dividend is outstanding, or dividend is about to be paid, or dividend will be paid, it means that the share price given to you includes dividend. That is CumDiv share price. You cannot use CumDiv share price to calculate cost of equity. It has to be XDiv share price. Therefore, what is XDiv share price? XDiv share price is the share price that excludes dividend. When calculating cost of equity, only the XDiv share price should be used. Hence, if CumDiv share price is given to you, it should be converted to XDiv share price. So let me just put a short note for you. This represents the share price that includes dividend. CumDiv share price CumDiv share price should not be used to calculate cost of equity. Should not be used to calculate cost of equity. Okay. From here. CumDiv share price should not be used to calculate cost of equity. If in a question, if in a question, examiner, let me reframe it. When dividend is about to be paid, or will be paid, or still outstanding. It means the share price is cum div and should not be used. It means the share price is cum div and should not be used. So in most cases, this is what the examiner, it is cum div that the examiner will give to you because they want you to make adjustments. On the flip side, let me put it as a heading, XDiv, share price. Come on. This word approach is stressful. It's more like I just relax. I'm the one doing the work. You see? In fact, this class is too quiet for me. Right? But it's what it is. All right. Let's move on.
Write on a whiteboard, which is better? A whiteboard.
It's not even a whiteboard. I don't use whiteboard. I use marker. Even on the whiteboard, you need the pen. It's because my pen is not connecting to my screen. That's why.
Hello,
Okay,
hello, sir.
okay.
I normally use the pen.
Hello, sir. Please,
Okay,
did
sorry.
you try restarting your system?
I've tried it. I've been trying it since
Wow,
yesterday. You
this is
know,
serious.
the class I had yesterday, I struggled. So that's why I have to devise this Word document today. I will get used. I will, of course, I will resolve it. So it's just that I did not have the time today to do it. So XDiv share price is the share price. This is the share price that excludes dividends. And it is the most appropriate to use for the calculation of cost of equity. All right. So it is XDiv share price you must use anytime you want to calculate cost of equity using dividend valuation model. Therefore, when CumDiv share price is given, it should be converted to XDiv share price as follows. Okay. XDiv share price is equal to CumDiv share price minus current dividend. Okay. This is how to convert CumDiv to XD share price. Alternatively, if you want to use the tabular format, you can say XD share price. Let me put it this way. Alternatively, it's the same formula, but here you are using table. Okay. Let me give a space. So alternatively, you can use a table to do the same thing. All right. This will be your Naira sign. On that, you have your div share price. Error. Okay. Then you have your current dividend, less current dividend. Whatever you have thereafter, it then represents your XDIV share price. Okay. This is how to calculate. This is how to calculate XDIV share price. All right. So I believe now you understand the concept of div and XDIV share price. The last thing we are going to discuss under cost of equity would then be estimating growth rates. You can see from this formula that we have growth rates. How do you calculate the growth rates? What are the methods of calculating growth rates? Let's discuss it. And possibly that's where we are going to stop for today. Estimating growth rates. Okay. How do you calculate growth rates? Generally, or ideally, shareholders will expect that the dividend earned from a company will expect that the dividend earned from a company will increase over time. No shareholder will expect to receive the same amount of dividends every year. Okay? The same amount of dividends every year due to price level changes. That is inflation. You know, inflation reduce the purchasing power of money. So as a result, for example, as a shareholder, if you earn a dividend of 1 million naira in 2024, for example, or in 2025, the value of 1 million naira in 2025 is not the same thing in 2026 because of inflation. The purchasing power of money must have declined. As a result, investors or shareholders will always demand for a higher dividend. Okay, we demand for a higher dividend. All right. No shareholder will want to be receiving the same amount of dividend every year. All right. So they always expect that the dividend will increase no matter how little relative to what they earned in the previous year. Okay. Dividend growth rates. Dividend growth rates can be calculated using any of the following methods. Okay, what are the methods of calculating growth rates? Okay. Method 1, using historical pattern. Historical patterns of dividend payments. Method 2, using Gordon growth model. These are some of the methods of calculating, or the two common methods of calculating growth rates. So let's break it down further. Historical pattern. Of dividend payments. When do you use historical pattern of dividend payment to calculate growth rates? Okay. This is used to calculate growth rates when information or when the history or past information about dividend payments are given. Okay, that is when you use historical pattern of dividend payments. It is also known as, let me put it this way. This is also known as averaging method. It is used to calculate growth rates when the history or past information about dividend payment are given. The formula below can be used to calculate the growth rates depending on the information available. Okay, any of these two formulas you can use to calculate your growth rate. Calculate. Okay. The first one, where the amount of dividend paid for all the relevant years are given. If in a question, you are given the amount of dividend paid for all the years, then you are supposed to use this formula. G would then be equal to G will be equal to square root. Let me see. I'm also teaching you how to use document in case you want to write a book. These are techniques of how to use Word document for typing. Even some people, even those business centers that are typing for customers, they don't know how to use this. And so this is not just about ICAN. Latest dividend, let me put ID. ID divided by, let me go back. Don't do as you do the other time. Okay. ID over BD. Then all minus 1. Let me remove. Okay. That's it. So this is the formula for calculating growth rates, where the amount of dividend paid for all the relevant years are provided in the question, where G equal to growth rates, N equal to number of years dividend is paid. Next, ID equal to latest or current dividend. Current year dividend next, BD equal to base year dividend or dividend paid in the first year. All right. So that's that. Let me demonstrate for you. Let's go further. For example, examiner can tell you, can give you information of dividend like this. Let me use a table. Should we use, let me use 2 columns. 3 years is, oh, okay. Let me use 2 rows then. Let me move to the next line. Let's move to the next line. Let me use something down. Let me use 2 rows instead of columns so that I can occupy the space. Okay. Let's say you have year 1, year 2, and then year 3. This is year. This is amount of dividend paid for each year. Let's say in the first year, dividend of 10 naira is paid. In the second year, 12 naira. In the third year, 13 naira. Let me include one more column. Then in the fourth year, dividend has increased to 15 naira. You will see that dividend is growing every year. Dividend has increased from 10 naira in the first year to 15 naira in the fourth year. That means there's a growth in dividend payments. So what is the dividend growth rate in this case? So whenever you are given information about the amount of dividend paid for all the years, that is when you use this particular formula. Okay? This formula should be used when information about when the amount of dividend paid for all the years are given. That is when you use that particular formula. So if you want to solve this particular hypothetical figures, what are you supposed to do? Very simple. All right. To solve this, you then say, you already know your formula to be n minus 1 into square root latest dividend over dividend paid in the first year. N in this case is 4 years. So here will be 4. Latest dividend is the current year dividend, and the current year is year 4. Dividend in year 4 is 15 naira. Dividend paid in the first year is BD, base year dividend. So dividend in the first year is 10 naira. Therefore, mathematically, I will put this in my calculator and I will get the final answer. So if you don't know how to use calculator if you don't know how to use calculator for this kind of expression, then you can convert it mathematically. In that case, I will then say, let me copy this guy, or let me rewrite it. I will just say G. Let me break it down further. All right. So you can then say G equal to 3 into square root 15 divided by 10 will give us 1.5. 1.5. Okay. Then all minus 1. So with this, I can then bring it down further to get the final answer. So my G will then be equal to G will be calculated as 1.5 raised to power 1 over 3. I will show you the formula to use, the second formula, just shortly. Let me see. So All right. Okay, I'll use this one. G equal to 1.5 1.5 raised to power 1 over 3. 1 over 3. Okay. Then all minus 1. All right. That's it. This will give you this will enable you, if you don't know how to use second function in your calculator. So this is what you are supposed to do. All right. What you have inside your square root, or what you have outside the square root, which is 3, will then become the power of what you have inside the square root. So in this case, if you want to get the final answer, you then say 1 divided by 3 will give us 0.3333, whatever. All right. So I'm not using, I don't have the calculator here. But in any case, I can say my G is equal to 1.5. Let me use the calculator that I have. 1.5 raised to power 0.3333. Let me see. Sorry, I used divided instead of raised to power. 1.5 raised to power 0.3333. Then minus 1 equal to 0.1447, then multiply by 100%. So this will give us 14.47. 14.47. You can try it at your end, ensure you get the same answer. All right. So it means that dividend has grown by 14%, approximately 14% in the last 4 years. Okay. This is how to calculate growth rates when information about when the amount of dividend paid for all the years are given in a question. Once you can see the amount of dividend paid for all the years, it means you are supposed to use the first formula for your calculation of the growth rate. All right. So the second formula under the historical pattern, the second formula is where, let me bring this one out. All right. Where the amount of dividend paid in the first year and current year are given. So if in a question, examiner only provides, you are only given the dividend paid in the first year and the current year dividend, then in that case, the formula will change slightly. All right, the formula will change slightly. Okay. So in this case, I would then say growth rate is equal to n into square root latest dividend over dividend paid in the first year, all minus 1. Okay, so this is the formula you are supposed to use when the dividend paid in the first year and the current year dividend are given. In the first year and current year are given. Okay, so for example, I have to resolve this issue of my pen. This took a lot from me today. I don't want to experience this going forward. Okay. For example, examiner can tell you that, okay, the dividend paid, 5 years ago is 10 naira. Why the current year dividend is 13 naira or is 15 naira for simplicity. So this is the way examiner will express it for you. Two extreme figures. You are going to be given the amount of dividend paid some years ago, and then in the first year, rather, and then you are also going to be given the current year dividend. So when you are given this kind of information and you want to calculate growth rate, you can see that dividend 5 years ago is 10 naira, but the current year dividend is 15 naira. Dividend has increased by 5 naira. So when you're looking at it in the face value, you can say, oh, dividend has increased by 50%. It is not 50% because what examiner wants you to calculate is the compound annual growth rate. Compound annual growth rate. And that is the formula we are using. Okay? So if you now want to determine the growth rate in this scenario, then G will then be equal to, let me copy what I've used before. Okay. So G will then be equal to, you can see this one does not have -1. So N is equal to 5. 5 into square root 15 divided by 10. Okay. So here will be 5 into square root 1.5. Then I can then use my calculator to get the final answer. Okay. So 1.5 raised to power, this is no more 3, this is 5. So this should then be 1 divided by 3. Sorry, 1 divided by 5. So 1 over 5 will be equal to 0.2. So using your calculator, you then say 1.5 raised to power 0.2 equal to then minus 1 equal to 100%. Sorry, equal to 0.08, then multiply by 100%. That will give us 8.45. The final answer is 8 points. G is equal to 8.45. So approximately G is equal to 8%. All right. So this
Sir,
is
please,
how
can
to
you take that again? Sorry, can you take how you got it with your calculator again? Sorry.
Okay. First thing, when you are using calculator, the first thing you can see this is 1.5 raised to power 1 over 5. So when you are pressing your calculator, you have to start with the power. So you are going to press from your calculator 1 divided by 5 equal. You leave the answer on your calculator. You then press 1.5 raised to power answer that you have in your calculator. You press equal to, then you minus 1. Then you multiply with 100%. It will give you 8.45. Try it again. Let me know if you get it correctly.
You said 1 point, I'll start with 1.5.
Yes, you are going to start with the power. You know, it is 1.5 raised to power 1 over 5. So you are
Yes.
going to start with 1 divided by 5. Start with
Okay.
1 divided by 5.
Okay.
Then you leave the answer on your calculator. 1 divided by 5 is 0.2. So you leave the
Yes.
answer on your calculator. Leave the answer on your calculator. Just type
Okay.
1.5.
Mm.
So 1.5 raised to power answer. There's a power sign on your calculator.
1.5.
5 raised to power the
Right.
answer you have for your calculator.
Okay. 0.2. Okay. I got 1.08447.
So minus 1. Minus 1.
Okay.
Then
Minus 1.
multiply by 100%.
Okay.
You are going to get 8.447. So 8.45.
Yes.
Yeah.
8.44. Thank
So
you.
that you are welcome. So this is how to calculate growth rates using the historical pattern of dividend payments. All right. So the last one we are going to discuss is Gordon growth model. Let's discuss Gordon growth model. And then that's where we are going to stop. Gordon growth model. When do you use Gordon growth model to calculate to calculate growth rates? This is used to calculate growth rates when information about earnings, and capital employed are given. So if in a question you are given profit after tax as well as capital employed, you don't need anybody to tell you that you are supposed to use Gordon growth model to calculate growth rates. All right. That is what you should look out for in a question. When you are given profit after tax, okay, you can call it earnings or profit after tax. It's the same thing. All right. So once you are given information about earnings and capital employed, you should know that you are going to calculate growth rates using the Gordon growth model. So the formula below can be used. The formula below can be used to calculate the Gordon growth. Can be used to calculate the growth rates. Okay. So using Gordon growth model, G will be computed as return on investment multiplied by retention rates. Okay. Sorry. I want to use small letter. All right. Let me go to the next page, next line. Where R equal to return on investments, or return on capital employed. Okay. Then B equal to retention rates. All right. What this simply means is that anytime you want to calculate Gordon growth, and you want to calculate growth rate using Gordon growth model, you need to first of all calculate the return on investments as well as the retention rates before you will be able to calculate the growth rate. So R will then be calculated as, let me copy this. Not here. Okay. R will be calculated as earnings, that is profit after tax, divided by capital employed. Okay. Multiply by 100%. That will give you the retention, sorry, that will give you the return on investments. Okay. At times, examiner may want you to use opening share capital as your denominator. So it all depends on the information available in the question. Okay. So if you are not given, capital employed can be defined in several ways, depending on the information available. Capital employed can be equity plus debt. It can be total assets. It could be net assets. It could be shareholder. It could be opening shareholders fund. Whatever the information you have in the question is what you are going to use to do justice to your calculation. Then the retention rates, which is B, will be computed as earnings. Let me copy this. So depending on the information available, if you are given absolute value, then retention rates will be calculated as earnings minus dividend divided by earnings. Okay. All multiplied by 100%. It is also possible in the question you may be given earnings per share. So if you have earnings per share, okay, if you have earnings per share, then your B, this will be calculated. Let me copy, including this. All right. So in case you are given earnings per share in the question, EPS. So this will be EPS minus dividend per share okay, over earnings per share. Dividend per share over earnings per share. All right. So when you are done with this, you have calculated your retention rates. You've also calculated your return on investments. Then can then proceed to calculate your growth rate. All right. Your retention rate can also be 1 minus dividend per share. 1 minus dividend payout ratio. Okay. You still get the same answer. So the information available will tell you which formula to use for the purpose of your calculation. All right. Okay. So this is where we are going to call it a day. Let me hear from you. Any question for me? He's very okay. Kenny. So any question for me? Thank you. So that we can close the class. In our next class, by the grace of God, we are going to be discussing how to calculate cost of preference share, how to calculate cost of debt. So if you still have time, then we move to cost of convertible securities. Okay? But my focus in our next class will be how to estimate cost of preference share and cost of debt. So it is after our explanation of all relevant concepts, then we begin to solve questions. Okay, so right now, what we are doing is to explain, to simplify the concept so that you'll be able to express yourself the way you want, not cramming. Okay, all right. So finally, any question for me so that we can close the class?
None from me.
Okay, let me see those that are still online. I can see Ibrahim Mohammed.
Yes, sir.
Still on. Well done.
Yes.
I can see Wikos.
Yes, I'm here.
Yeah. I can see Abigail. I can see Abiodun. I can see God's Power. Adetola, Adewale Kehinde Raphael, Shakirat, Dekunle, Faith, and every one of you.
Yes, sir.
Yeah, Debbie, Femi Balogun, Fortune, Glory, Ibrahim. Okay, I've mentioned Ibrahim before. Ife, Jeremiah, Matthew, Olakeni, then Olaide, Simbiat, Olórúkọ ńlá. Oluwatosin.
Active, sir.
Felicia, Promise, Beatrice, Samuel, Possibility, Ajasa, Sonia, Temitope, then Toluwani, then I also have Yetunde. I thank every one of you for waiting behind up to the last moment. I really appreciate your support. By the grace of God,
as well, sir.
Thank you.
So I mentioned Kenny. I mentioned
Rachel,
sorry, Kenny.
Rachel.
Oh, Rachel, yes. Sorry for that.
Thank you, sir.
You're welcome. So by the grace of God, we are going to meet again next week, Tuesday, when we shall continue our explanation on cost of capital. Thank you once again. See you next time by the grace of God. Good night.
Good night, sir.
Thank you very much, sir.
We really appreciate your time.
Good night.
Welcome.
Who is taking up the next time?
Yeah, welcome. Mr. Ali will take it on Friday.
Okay.
Yeah.
Thank you.
You're welcome. Okay.